Today we're going to talk about 3 ways to lower your monthly payment or have no payment when buying a house. Hey guys, this is David Xie with the Xie Mortgage Team. We are constantly getting bombarded with questions on how can I afford the house? Or with everything being as expensive as it is, I mean, it's rich to have a couple dozen of eggs nowadays, because the other day I went out and bought some organic eggs because they were cheaper than what I could get at the grocery store. So we're always looking to save some money. So number one, we're just going to go ahead and get this right out of the way, because this is probably the most unpopular way to get a loan because of what happened in 2008, 2009, and 2010, and that is an adjustable rate mortgage. What is an adjustable rate mortgage? An adjustable rate mortgage is a mortgage that you get, and you're going to get a teaser rate for a certain period of time, and that's typically from 6 months all the way to 15 years. With that rate, it's typically going to be lower than the current market fixed rate, and after that certain period of time, from 6 months to 15 years, it's going to start adjusting on you, and it's going to be adjusted based on a certain market indicator such as the LIBOR. And with that, we take the LIBOR, and there's going to be a cap and there's going to be a floor on it. So it cannot increase by more than a certain percent, or it cannot drop more than a certain percent on that at that certain period of time, whether it's 6 months to 15 months. And then it can adjust every 6 months, every 12 months, and even longer, depending on the different types of terms. There are standard Fannie and Freddie adjustable rate mortgages, same thing with some certain government loans. And then there are loans that banks specifically have called portfolio loans, where they use different indicators for their adjustments on the adjustable rate mortgage. Number 2 is a temporary buy down. This is a lot more popular now, and we usually see this when the housing market starts declining some, and we've seen a decline, so you've probably seen a lot of videos on doing a temporary buy down. The way that these temporary buy downs work is it's typically a cost paid for by the seller to market their home and sell it a little faster. With that temporary buy down and that additional marketing, the seller is going to pay for the cost of the lender giving you a discounted rate up front, and that's called a temporary buy down, to give you a lower rate for the first X amount of years that you have the loan. So we've all heard of a 1-1 buy down, a 2-1 buy down, and a 3-2-1 buy down. So we'll go with a 3-2-1 buy down because it's a lot easier to explain, and you'd understand by the end of this 3-2-1 buy down how the rest of the buy downs work. But if we have time, we'll address those first. So a 3-2-1 buy down is going to work like this. Let's say your current interest rate is 6% on a fixed rate right now. On a 3-2-1 buy down, you'd get a 3% drop on the first year on that interest rate. So you'll start out with a 3% interest rate year 1. For the first 12 months, you're going to be making the payment based on that 3% interest rate. Year 2 comes around, you're going to get a 2% drop on that interest rate. So it's going to take the interest rate to 4%. 4% for 12 months, and then it's going to go to 5%, which is a 1 buy down. So the first rate was a 3% buy down, a 2% buy down, and now the 1% buy down. Now you're going to have the 5% rate for the next 12 months. 12 payments of 5%, and then all of a sudden it settles on that 6% interest rate. So this is a really good option for someone that thinks that the rates are going to go down. And during this 3-2-1 buy down, or 2-1 buy down, or 1-1 buy down, you'd be able to have that opportunity that during that time of having that temporarily lower rate, you're going to be able to convert it into a fixed rate, hopefully, with a cash out refinance. So that's something that you should weigh out. Should I take the funds from the seller to buy down the interest rate permanently on a fixed rate mortgage, or should I take advantage of these temporary buy downs? That's something that you're going to have to figure out, because I don't have a crystal ball, so I can't tell you what the future is going to hold. But my prediction is that I think that the rates will be coming down here in the future. And finally, reverse purchases for people that are over 62 years or older. This could be a reverse purchase. This could be a reverse refinance. I really had a lot of negative thoughts about these loans a while back. And now with me looking at the entire housing market and seeing how everything is, you know, it does kind of make sense to have these reverse purchases and reverse refinances. And I'll just use my own personal situation as a factor. So my mother, she's 70 years old. She's been in her house for a long time, and her previous house she paid off. She sold that house and went to a one-story house. So with that one-story house, it was number one in a way more desirable area, so the values have gone up. And one-story houses always sell. You know, if you've heard me talk about my investment options and what I like to invest in, I really enjoy investing in single-story, single-family homes because those increase in value the most. And regardless of the market and regardless of the type of family composition you have, a one-story house always makes sense. If she were to go into the reverse mortgage, which would be a refinance at this point because she has a little mortgage on it, she could actually go into it, and instead of it being a forward mortgage where every single month she makes a payment and the payments continue to go down, a reverse mortgage, the payments continue to go up every month because you're not making a payment. The equity goes negative. However, when you look at it long term with the housing market, hopefully that housing market is going to do this cyclical thing, right? You know, and hopefully it's, let me see the angle of the camera. Okay, so it's doing this cyclical thing, right? Up, down, and hopefully it gets to this point where it goes up. Okay, so when that value continues to go up, we're also hoping that, you know, this value continues to go up with it. And hopefully this value is higher than what you owe on it when you get rid of the house. So when she passes away and there's no one else living in that house, that reverse mortgage has gone up, but the value has also gone up. So we can take that gap and she could sell that house and we would have to deal with the consequences of what she owes on the house, which is not a bad thing when you think about it, because I don't expect my 70-year-old mother to live forever, number one. And number two, I don't want to burden her with that obligation of thinking that she has to leave us with a certain amount and live a lesser quality of life while she's still here with us. These three really good reasons and three really good ways to get your mortgage payment down or to get into a house in 2023 without a payment. So if you have any questions or concerns, give me a call. My name is David Xie and I'm with the Xie Mortgage team. I'm a wholesale lender here at Nexa Mortgage and I'd love to help you out on your next mortgage. 757-478-8493. Comment below if you have any other suggestions. I love to hear comments. If you have any video suggestions or want me to talk about anything in particular, I'd love to address those. And be sure to subscribe to our channel and like this video, and I will talk to you later. Peace.